Today we're going to talk about the repo market, what it is, a brief history of it, and why you should incorporate it in your trading. At the end of the video, I'm going to do an analysis of today's status of the repo market. So the first thing that you need to know is it is a $10 trillion market. Almost nobody talks about it. The mainstream investing community doesn't talk about it. And I'm going to tell you everything about it and also why in 2019 it almost broke. This is the repo market. A repo stands for repurchase agreement. Let's say you're party A, a bank, and you want to sell a US Treasury to party B. Party A agrees to buy it back tomorrow at a slightly higher price. That difference is the interest rate, and it's the repo rate. It is a collateralized overnight loan. Think of it like a pawn shop, but for banks. You bring your Rolex, a treasury bond, and you get cash tomorrow to pay back the cash plus a little extra, and you get your Rolex back. The pawn shop never wanted their watch. They just wanted the interest. So you are Goldman Sachs and you bring the treasury to the standing repo facility. So the mechanics. What are the mechanics of a repo trade? Let's say a dealer needs $1 billion overnight and the dealer sells 1 billion in T-bills to a money market fund. The dealer agrees to buy them back tomorrow at 1 billion plus interest. So the repo rate, the annualized interest rate, is the difference. So if the repo rate is, let's say, 3%, that doesn't mean that you're overnight getting 3%. If you keep lending that every single day for 1 year, your rate would be 3%. Overnight repo rolls every day, term repo, fixed period, 1 week, 1 month. What are the players? Which institution engages in these repo trades? The borrowers, the sellers of collateral, are investment banks and dealers to fund their inventories. Hedge funds use leverage to increase their exposure, which means they increase their risk. And US Treasury short-term government financing. The lenders are the buyers of collateral, let's say money market funds, central banks, and insurance companies that they park their excess cash in. You need to know there are 2 rates and 1 goal: to control the price of money. This is how the Fed sets the price of money. The first is the Fed fund rate. It's what you hear every 6 weeks on the F1. It's the rate at which banks lend to each other overnight, unsecured. It's at 3.50 and 3.75. That's the current Fed fund range. And this is the one that the Federal Reserve sets on their FOMC meeting. The repo rate is anyone borrowing cash overnight using collateral, secured. The secured overnight financing rate is very similar to the Fed funds rate. They are very similar. They move together, but they are not the same thing. The repo rate is usually slightly below the Fed funds rate because repo is secured. Because you have collateral, that means less risk, and that equals a lower rate. The Fed uses the 2 facilities to keep interest rates in the target range. The standing repo facility is the ceiling. Why is it the ceiling? Because nobody will want to pay more than what the Fed is offering. The Fed's funds target range is between 3.5 and 3.75. The floor is the overnight reverse repo rate. The standing repo facility is the rate that banks can always borrow from at the Fed. Rates in the repo market can't go above it, because why would you pay more when you can just borrow from the Fed? That's why this is the ceiling. At the bottom, you have the overnight reverse repo facility. Money market funds can't park cash at the Fed at this rate, so rates can't go below it. Everything in between is where the Fed funds rate and the repo rate live. The Fed moves both guardrails together when it hikes or cuts. So this is the ceiling for rates, this is the floor for rates, and this is the target range. This is where the rate should be. So let's go into the history of the repo market. In 1917, the Fed invents repo during World War I, a tool to inject cash without permanently expanding the monetary supply. Nobody imagined it would become the backbone of global finance. In 1982, Drysdale Securities, the first weaponized repo, borrowed $4 billion in treasuries via repo. Imagine $4 billion in that time's money. Remember, we were just coming out of the gold standard here. Use them to short the bond market. So they borrowed treasuries via a repurchase agreement and they shorted the bond market. Because a short means you borrow the underlying security and you promise to buy it back. So you borrow it You sell it to the open market, let's say for $100, and then if the price goes down, you buy it back for, let's say, $90, and then you keep the difference. They used them to short the bond market. It collapsed, nearly took down Chase Manhattan. The market had no rules, and it needed them. In 2008, this is the Lehman Brothers collapse. The repo run that killed Bear Stearns and Lehman Brothers, both firms funded 25 to 35% of the entire balance sheet overnight via repo. When confidence broke, counterparties stopped rolling their loans. And you need to roll over a loan for it to be invalid. Overnight, Bear Stearns was gone 72 hours, Lehman in a weekend. Not a traditional bank run, a repo run. Institutional, silent, and lethal. Now, in 2019, one morning, the rate goes from 2 to 10%. This spike is right here. 2019 says 10%, corporate tax payment, a large treasury action settling on the same day. Post 2008 bank regulations that left banks unable to step in, the repo market froze, so the Fed injected $75 billion in one day. It's the first intervention since 2008. 2020-2022, COVID QE. Remember that the Fed needed to stimulate the economy and they started quantitative easing. March 2020, the repo market seized. The Fed launched unlimited QE, buying $120 billion a month of treasuries and market-backed securities. Banks were flooded with reserves. Money market funds had so much cash, they had nowhere to put it. All those excess liquidity that money market funds had ended up in the reverse repo facility. Later, because from the time that the Fed injects the liquidity to the time that it becomes excess liquidity, it takes a year. All of this excess liquidity peaked in 2023. Now in 2022, in December, $2.5 trillion. That was like a cushion for the market. They started parking trillions at the Fed's overnight reverse repo facility. By December 2022, it hit 2.5 trillion. This is the peak. The system was drowning in liquidity and the repo market reflected it. Now, the important part. What are the charts telling us right now? Right now, the repo market shows two charts you need to know. The overnight repo and the reverse repo. The first chart, the overnight, peaked in 2.5 trillion in December 2022, and today is between 6 and 12 billion. Overnight reverse, 5, 6 billion. It's really nothing. May 2026, it's even less. Not even $1 billion in excess liquidity. All COVID-era excess liquidity has been completely drained. Money market funds no longer need to park cash at the Fed, and the tailwind is gone. The second chart that you need to know is the standing repo facility. And on December 31st, 2025, banks borrowed $74.6 billion in total, and 31.5 backed by Treasury securities, and the other 43 backed by mortgage-backed securities, dropped back to zero by January 2, 2026. December 2025, it peaked at 31 point something, and it drained back to zero. So what does this tell? If this is the reverse repo and money here shows excess cash, then the normal repo shows borrowed cash, which means they have a liquidity crisis. The Fed chart shows only the treasury portion, which is 31.5 billion, but the full 74.6 billion includes mortgage-backed securities, which is another chart. What this means, the year-end bank stress, same fingerprint as 2019. This shows the same pattern as the 2019 crisis and the repo agreements. So let's go back to 2019, around here. Repo rates influence short-term interest rates across all markets. The treasury yields will be affected by repo rates. But when the repo rate freezes, the credit tightens and everything sells off. This happened last year. This was the first signal of a bull market top. The first signal was this December, needing $74 billion. The Fed had to inject $74 billion because there was no liquidity. How can a bull market continue if there is no liquidity? Around that time, Bitcoin was topping out. December 31st, 2025. See? It already had crashed, and this was your signal to not buy the dip. What happened after this? it crashed everything. What happened before? The first signs was October 31st. So all the professional investors, what they did is they saw this and they understood perfectly. Banks have no liquidity. How can a bull market continue with no liquidity? And you can see it here. It was October. If you had sold on October 31st, you would have sold near the top. When Bitcoin lost its 200-day moving average. Repo stress equals early warning signal of systemic risk. The Fed uses reverse repo and repo facilities to hold rates in the target range. They inject liquidity whenever the rate goes too high or too low. If the overnight reverse repo drains to zero, the liquidity buffer is gone. The market had been rallying because there was this huge liquidity buffer on the overnight reverse repurchase agreements, and now it's drained out. So this means that there is no excess liquidity to buy dips. So this increases the risk of a crash. And you need to watch the SRF because record spikes equals banks under stress and it equals risk of incoming. So that's everything you need to know. This is only the start of a series of videos I'm gonna be doing about financial education, hedge fund strategies, and everything you need to know about financial markets.